Welcome to Iron Financial. I'm your lead analyst. Today, we are putting Celsius Holdings directly under the forge. Their latest earnings report absolutely lit up the market, sent the stock screaming higher, but here's the real question. Is this a fortress they're building, one made of solid steel, or is it just a house of cards, beautiful to look at, but ready to collapse at the first sign of trouble? Our mission today is simple. We are going to stress test these numbers, piece by piece, and figure out if Celsius is a core holding that reinforces your portfolio or a critical weak point that's just waiting to buckle. Let's get to it. Okay, so the bull case, the argument for strength, it starts right here with this number, $721.6 million. That's their revenue for the fourth quarter alone. Now, this isn't just a good number, it's a massive beat on what the analysts on Wall Street were expecting, and it's a crystal clear indicator of pure market dominance. You have to remember, the energy drink market is insanely crowded. It's a knife fight on every single store shelf. And a number this big shows that Celsius isn't just competing anymore, they are actively taking over shelf space and winning consumer dollars hand over fist. This is the top line number that grabs everyone's attention and makes them sit up and listen.
And then you see this. This is the figure that really poured gasoline on the fire and fueled that massive rally in the stock, a 117% year-over-year revenue increase for that fourth quarter. Let's just let that sink in for a second. The company more than doubled its revenue in just 12 months. That isn't just growth, that's hypergrowth. It is the absolute definition of a company firing on all cylinders. And it's the primary exhibit for why this stock has had such incredible positive momentum. This right here is what investors are paying a premium for. They're paying for speed.
And look, the narrative coming directly from the top, from the command center, it just reinforces this entire picture of overwhelming strength. The chairman and CEO, John Fieldly, he comes out and calls 2025 a defining year. Now, when a CEO uses words like momentum, scale, and confidence in a single breath, they are not just talking about the past. They are painting a very specific picture for investors of a company that isn't just growing, but is in complete and total control of its own destiny. This quote is designed to frame the entire bull case that Celsius has successfully built an unstoppable empire. Okay, hold on a minute. Unstoppable empire? Those headline numbers are impressive, I'll give you that. But at Iron Financial, our job is to look deeper, to inspect the welds. As market skeptic, I have to ask the hard questions. And the biggest question is this. How much of this incredible jaw-dropping growth is actually organic, coming from their core product that everyone loves, and how much of it was just bought? Simply going out and acquiring your competitors is a really easy way to make your revenue number look bigger, but making that growth profitable, making it sustainable, well, that's a whole different ballgame. That's the real challenge. So let's pull back the curtain and see what's really going on. All right, so this is our blueprint for today's analysis. This is how we're going to drill down. First, we'll look at the big picture, that massive $2.5 billion shockwave from the full year. Then, and this is crucial, we are going to deconstruct their growth engine to see exactly where that power is coming from. After that, we'll solve the profitability puzzle because we're looking at two earnings numbers that tell completely different stories. From there, we'll dive into the tale of their three key brands. Then we'll inspect the financial foundation itself, the balance sheet. And finally, when all the evidence is on the table, we will deliver the Iron Financial verdict. Okay, let's get into it, starting with that full year performance. Because to even understand the debate we're having here, you have to appreciate the sheer scale that this company is now operating at. This isn't some small, scrappy niche player trying to make a name for itself anymore. Celsius is a dominant force, a heavyweight that has to be taken very, very seriously by everyone in the industry. $2.5 billion. That's the revenue for the full year of 2025. That number doesn't just put them in the major leagues, it firmly plants them as a heavyweight contender in the entire energy sector. We're talking about them commanding roughly 20% of the whole US market. Now, that kind of scale isn't just for bragging rights. It gives a company immense leverage with distributors, with retailers, and it gives them the capital to fund marketing campaigns and innovation that their smaller rivals simply cannot afford to match. A number of this big changes the entire conversation around the company. And this bar chart, this really puts that growth into a startling perspective. You can just see the jump right here on the screen, from $1.36 billion in 2024 all the way up to $2.52 billion in 2025. They added over $1 billion in revenue in a single year. That nearly doubled the size of the entire company. This isn't a gradual climb up a mountain. This is a vertical launch into orbit. But, and this is a big but,
A launch this fast and this steep is exactly what raises some critical questions about the quality and the sustainability of that growth.
Exactly. A vertical launch is impressive, no doubt about it, but it can also be incredibly risky. If the engine isn't built right, the whole thing can fall apart on the way up. So we need to know what's fueling this growth. Let's deconstruct this growth engine. Let's take it apart, bolt by bolt, and see precisely where that extra $1 billion in revenue actually came from. Because the source of that growth is the absolute key to understanding this company's future and whether its current sky-high valuation is even remotely justified. And right here, this is the fundamental question that separates the bull case from the bear case. Is this real, organic growth which suggests a sustainable internal strength in the company? Or did they just go out and bolt on growth by buying other companies? Because that comes with a whole host of risks, hidden costs, and massive integration challenges. One of those stories is worth a high valuation. The other one is far, far more questionable. So let's stop speculating and just look at the data.
And wow, the data tells a very, very clear story. This donut chart breaks it all down for us, the full year revenue. The core Celsius brand, that's the big orange slice, made up 58% of the business. That's the foundation. But look at this massive blue slice right next to it. That's Alani New, a brand they acquired. It brought in a full $1 billion on its own. That's 40% of the total revenue. Then you add in that little sliver from Rockstar, and you quickly see that over 40% of the company's entire revenue stream came from these newly acquired brands.
Let's be really explicit here so there's no confusion. The total revenue increase from 2024 to 2025 was about $1.16 billion. Now, the combined revenue from the two brands they just bought, Alani Nu and Rockstar, was $1.06 billion. The math is simple. This means that nearly all of the company's celebrated headline-grabbing growth for the entire year was inorganic. It was bought and paid for. Now, that doesn't automatically make it bad, but it completely changes the narrative. This isn't a story of organic success anymore. This is a story of growth by acquisition, which is a much more complex and a much, much riskier strategy to pull off. And that growth by acquisition strategy leads us directly to the next critical area, profitability. And you're right, the numbers here are complex. On the surface, it looks messy, there's no denying it, but this is the unavoidable complexity you get with such a rapid, massive expansion. I'd argue the underlying profitability story is actually quite strong, but you have to be willing to look past all the short-term construction noise to see the true earning power of the combined company they're trying to build. Short-term noise? Are you kidding me? Look at these numbers. The official story, using generally accepted accounting principles, that's GAAP, the actual rules, shows earnings per share of 25 cents. That is down a shocking 44% from last year. Let me repeat that. The company doubles its revenue, but its official profit gets cut nearly in half. That is a massive, blinking red flag. But then you look to the right, at the adjusted, non-GAAP number they want you to focus on, and it's up 91%. How is that even possible? Are they just using accounting tricks to hide the true cost of these acquisitions? Which number here actually reflects reality? Look, both numbers are real, but they tell different parts of the same story. The huge gap between them, that's the price of that massive expansion. Non-GAAP earnings are designed to exclude significant one-time costs that management argues don't reflect the ongoing health of the business. In this case, that's over $327 million in payments to terminate their old distribution contracts. Why? So they can move all their brands over to the much more powerful PepsiCo system. It also includes nearly $60 million in direct acquisition and integration costs. These are real cash expenses, yes, but you have to see them as investments in building a larger, more efficient company for the future, not as signs of some operational failure today. And management has been totally transparent about this. They are on record guiding the market that once these one-time integration costs are fully absorbed and behind them, they expect their gross margins to return to a very healthy low 50% range in 2026. This is their way of telegraphing to the market that the current pressure on profits is temporary. They are signaling that a stronger, more profitable structure is being built right now, and what we're seeing is simply the short-term cost of that heavy construction. A long-term strategic reinforcement that only works if the pieces you're bolting onto the frame are actually strong. You can't forge a powerful empire with faulty materials. The whole thing will just crumble. So before we just accept management's rosy forecast, we need to inspect each component of this new portfolio, because a company is only as strong as its individual brands. It's time to take a hard look at this tale of three very different brands. Let's start with the crown jewel of their acquisition strategy, Alani Nu. This brand is an absolute rocket ship. Retail sales were up an incredible 101% in 2025. This proves that Celsius didn't just go out and buy revenue. They acquired a legitimate high-growth asset that has genuine consumer buzz and a loyal following. And now, they're leveraging their superior PepsiCo distribution system to pour fuel on that fire and accelerate that growth even further. From a strategic standpoint, this looks like an incredibly smart move. But maybe that smart move is just a distraction from a very serious problem brewing in the main engine room. While everyone was oohing and awing over the shiny new toy, the core Celsius brand, the brand that built this entire company, saw its reported revenue decline by 8% in the fourth quarter. You cannot build a durable, lasting empire if your home kingdom is shrinking. So is this a sign that management took its eye off the ball? Is the core brand, the heart of the company, starting to lose steam? That's a complete misreading of the data. The company explicitly explained that the 8% dip in reported revenue was not from a drop in consumer demand at all. It was a timing issue, a logistical hiccup related to the incredibly complex transition over to the PepsiCo distribution system. In fact, if you ignore the wholesale numbers and you look at the retail sales from the stores, what consumers were actually buying off the shelves, that number was up 13% in the exact same period. The data shows consumer demand remains very strong. This appears to be a temporary logistical headache, not a fundamental sign of brand weakness. Okay, fine. Let's say I accept your explanation for the core brand for a moment. You absolutely cannot explain this away. Rockstar Energy. Retail sales for this brand fell 11% in 2025, and its distribution points, the number of stores it's in, dropped 17%. This is not a timing issue. This is a brand in clear, undeniable decline. So the real question is, why on earth would a high-growth company go out and buy a depreciating asset? Is this some fixer-upper that is going to divert precious capital and management focus just to stop the bleeding? This looks less like a strategic component and a lot more like a problem child they've just adopted. That is a fair challenge, but it's one they appear fully equipped to handle. And that brings us to what I believe is the most important part of our analysis today, the financial foundation itself, the balance sheet. An aggressive, ambitious expansion strategy like this is only viable if the company has the financial fortitude and the discipline to manage all of that complexity. And the most recent data shows Celsius is demonstrating exactly that kind of discipline. Let's just look at their capital allocation in the fourth quarter alone. While they're in the middle of spending hundreds of millions of dollars on these complex integrations, they were still generating enough cash to pay down nearly $200 million in debt. On top of that, they turned around and bought back almost $40 million of their own stock. These are not the actions of a company that's struggling. These actions signal immense confidence from management. They're broadcasting to the market their firm belief in the company's financial strength and its future prospects. Confidence is one thing, the hard numbers are another. Let's look at the total load this foundation is actually carrying. Yes, they have almost $400 million in cash, which is a solid cushion, I'll grant you that. But they are also carrying nearly $670 million in long-term debt. And you have to add in this other line item that people often miss, $264 million in accrued distributor termination fees that still have to be paid out. That's nearly $1 billion in total obligations sitting on the books. These are significant stress points on the structure that you can't just brush aside. And management isn't brushing them aside at all. They provided a clear, transparent plan for getting past this period of unusually high spending. You can see it right here on this timeline. The Alani new integration, the easier one, will be substantially complete by the end of this current quarter. The more challenging Rockstar integration is slated for completion in the first half of the year. The crucial point here is that there is an end in sight. This timeline marks the point when the heavy spending should stop and the true underlying financial strength of the combined empire should finally become clear for everyone to see. All right, we have stress-tested the entire structure. We've looked at the explosive growth, we've untangled the profits, we've inspected the individual brands, and we've put the balance sheet under the microscope. It is time to weigh all the evidence. It is time for the iron financial verdict. Has Celsius successfully forged a solid, durable investment for the long haul, or are there hidden cracks in this armor that could lead to a catastrophic failure? The bull case, the argument for a solid frame, is powerful. We're looking at a company with a massive $2.5 billion revenue scale, absolutely incredible 142% adjusted EBITDA growth, and a dominant 20% market share. They're disciplined, paying down debt, buying back stock, and they've given us a clear integration timeline. This looks like a company that's being built to last. But the bear case, the cracks in the armor, is just as compelling. That incredible growth is almost entirely from acquisitions, not from their own organic strength. Official GAAP earnings plunged 44% because of those huge one-time costs. The core Celsius brand itself is showing signs of a slowdown, and they knowingly bought a declining asset in Rockstar that's going to require a costly turnaround. And looming over all of this is the biggest crack of all, an absolutely astronomical valuation with a price-to-earnings ratio over 500, that is pricing in nothing less than absolute perfection. And this brings us right to the final question that you, as an investor, have to answer. On one hand, you have a company that is executing an incredibly ambitious, empire-building strategy with remarkable scale and power. But on the other hand, the market has already rewarded them for it with a valuation that leaves absolutely no room for error, no room for a single misstep. So, is Celsius a high-strength steel investment, a high-growth compounder that will continue to dominate the market for years to come? Or is it a high-priced gamble, a valuation that's simply too hot to handle, one that could collapse under the weight of its own lofty expectations? That is the question you have to answer before deciding if it belongs in your portfolio. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.